This topic next is impairment of assets, and it is actually your standard, which is IAS 36. A very important standard, very frequently tested. You wouldn't get a separate question for this standard, but you may get it as part of consolidation, or you may get it as part of another question. Impairment of assets. And which assets we talk about? Assets could be under IAS 16, your tangible non-current assets, could be under IAS 38, your intangible non-current assets, or it could be your IAS 40, your investment property. So the impairment principles will apply. And actually impairment also happens to financial assets, IFRS 9, but there the concept of impairment is a little bit different. So the word impairment will be used, but the standard will not be IAS 36 because it has its own criteria. Impair actually means when the value of something goes down. That is called impairment. So in general, now this is going to be a very technical lecture, and we might be finishing it in 2 sittings because there are many aspects to deal with. Because it has, the concept is simple, not really very difficult, but it has many different areas to discuss with. In general, what happens that you have your depreciation, which is your expected loss in the value of asset, or which is expected reduction in the value of asset. Let's suppose that you have an asset for 100 and you estimate that it has 5 years life and depreciation is 20 per year. So what happens that 1 year later it becomes 80, and the second year it becomes 60, and the third year it becomes 40, and this is your book value. Okay, so according to your books, at the end of year 3, your asset should be, at the end of year 3, your asset should be 40. But then you find out that in market, this asset is for 35. So the market has dropped faster than your calculation. You estimated that asset would be 40. It is in your books 40, but you see that the recoverable amount from the asset, the word is recoverable amount, what you can recover, and what is that I will explain, is only 35. So now it looks like that the asset is overstated in your books. In your books, the asset is measured or valued at 40,000, 40 million, whatever. Whereas in reality, the value of the asset is 35. What you can recover from the asset is only 35. So this is a situation where you call impairment has happened. You can consider impairment as downward. We call it downward revaluation. Because in revaluation, the value of asset goes up. In impairment, the value of asset suddenly, unexpectedly, it goes down. It comes down. So what happens that now so it looks like that I charged 20 depreciation here, I charged 20 depreciation here, I charged 20 depreciation here. So I charged total depreciation 60. So 100 asset becomes 40 because I charged 60 as depreciation. Actually, I should have charged 5 more so that it becomes 35. So this 5 is called impairment loss. This is kind of an extra depreciation or downward revaluation, and we need to take this loss. This is our loss. Principally, now, because you have impairment of investment property and you have impairment of tangible of a property, plant, equipment, IAS 16, the treatment is different. Concept is same, but how I'm going to charge it, where I'm going to charge it, that is a difference. So these are the areas we are going to cover in this chapter. Like I said, that there would be many little complicated or little minor details which we need to discuss about this topic. So it's not very straightforward. We will talk about impairment of cash generating units. We will talk about impairment of goodwill, accounting treatment of an impairment loss. So there would be quite a lot of stuff coming up. So impairment of assets. What we need to understand first is what is recoverable amount. I'm going to explain you this concept now in 2 minutes. Then theoretically, we need to understand what are the impairment indicators. We call it impairment review. When do you review? When do you do a review for your asset if the value has impaired or not, if your assets have impaired or not? So we need to understand what are the impairment indicators. Indicators could be internal or indicators could be external. So we need to understand, this is the theoretical side of this thing. Then we understand what are cash generating units and how do we allocate impairment of, because it is possible that sometime some particular asset has impaired. For example, in your balance sheet, you've got different assets. This asset is 1,000, this asset is 2,000, this asset is 500. And then you find out that this particular asset, its value is 900. So it means that impairment has happened to this one asset. 100 impairment has happened to this one asset. This is impairment on one particular asset. But sometimes what happens that you have a business and the business value is 5 million and business has many assets and this business market value goes down to 4 million. So there isn't 1 million impairment, but this 1 million impairment is not on one particular asset. In fact, it is on a cash generating unit. It is on your SBU, strategic business unit. So this 1 million impairment, you have to apportion to the different assets within the business. It is also possible that you have multiple cash generating units. And this cash generating unit was 5, this was 5, this was 4, this was 3 in your books. Together it makes 17, together it makes 17. Now market is 15. So you have 2 million impairment. Now this 2 million impairment, how to charge it to these different units. And then within these different units, how to charge it to different assets. Understand? So like I said that if we go into detail, which we will go into detail, this topic would become a bit more complex. It has quite a lot of details. Okay. So like I said, that don't get scared. We'll go step by step and these things will be easy because all of these things will be handled logically. So once our logic is clear, then we will be able to understand if it is on asset, very easy. If it is on one unit, how to split it between that assets of one unit. If it is at group level where you have multiple cash generating units, then first take this impairment to individual cash generating unit, then within individual cash generating unit, charge it to this different assets. But the logic, the principle, we will follow the same. So the same principle will apply. So it should not be very difficult. And then last of all, we need to understand there is a concept which is called reversal of impairment. Now, reversal of impairment is not very popular in exams. It is not very popular in exams, but it is a technical topic and it is important topic also from real life, because it is possible that asset has lost value and after some time it recovers the value. Then what do we do? So we call it reversal of impairment. So this is again we need to discuss. Now, before we move forward, we need to handle recoverable amount concept. So let's go back to our Excel because I need to write down some numbers in Excel. So I hope that you guys can see now Excel file, right? Can you see Excel file now?
Yes.
Okay. Let's suppose that you had some asset which had a cost of, let's suppose, 20,000. It had so far depreciation, and let me call it accumulated depreciation. So the accumulated depreciation on this asset is, I don't know, minus 6,000. So it means that this asset had 14,000 as book value. I call it my net book value. So I'm using my cost model. I'm using the cost model, and based on cost model, there is some particular asset which is shown in my books at $14,000 as its net book value. Then there are other valuation method of asset. You remember that assets are valued at historical cost method or cost method, which we used here. There is something which we call here, which is like, NRV, okay? Or it is also called realizable amount. Or you can also call it fair value minus expenses to sell. So you call these numbers, it's the same thing, okay? It's the same thing. If I take this asset to the market, what is its selling price? What is its fair value? So I can say that its fair value, if I take it to the market, the fair value of this asset is, let's suppose, 15,000. Let's call it 14,000. 14,000. And its expenses to sell, because somebody will sell it and there will be some expenses to sell, are 500. So I can say that this asset has a realized value, realizable value, 13,500. Let me call it its NRV. So I've got an NRV or realizable value or fair value minus expenses to sell at 13,500, which means that this asset in my books, it is 14,000. If I sell it in the market, I can get 13,500. Now, you know that non-current assets are not there for selling. You have two options. Either you use it or you sell it. This is the case where you are selling the asset, okay? If you sell the assets, this happens. Alternatively, you may decide to use the asset. If you use the asset, what will happen? You can use this asset for the next 3 years. And this asset will give you 5,000, 5,000, and 5,000. 3 amounts it will give you. This is year 0. This is year 1, year 2, year 3, and this is year 0. Now, I know that this asset will give me 5K, 5K, 5K. Total, it will give me 15,000. But this 15,000 is not coming to me in one day today. In fact, it is coming in the next 3 years. And we know the concept of time value of money. We know the concept of time value of money. We know that this 5,000 today, 5,000 in year 1, it is not equal to 5,000 today, because $1 today is not equal to $1 tomorrow, because money loses value with time. We know present value concept. We know discounted value concept. And by the way, I will discuss this concept, discounted value, in more detail with you separately. We do not need to cover discounted value and weighted average cost of capital and discount factors in detail for this subject. We do not need it, but I will cover it as an extra topic because I believe that you should know that what are the discounted values, what are the discount factors, how to calculate discount factors, what is actually cost of capital, what is cost of equity, what is cost of debt. So it's a financial management topic. I will not cover it in great detail because we are not doing financial management, but I will give you the basics, but that will be later on. So far, I only know that this 5,000, which I get after 1 year, is actually not equal to 5,000 today. It might be 4,700. It might be equal to 4,700. Which means that what you can buy in 4,700 today, the same thing, if you want to buy after 1 year, you will be needing 5,000. So today's 4,700 is equal to tomorrow's 5,000. And this 5,000 which you receive after 2 years, it is not equal to 5,000 today. It might be equal to 4,500 as of today. It might be 4,500, which means that what you can buy in 4,500 today, the same thing will become 5,000 in 3 years' time. Or you can consider that if I put my money 4,500 in the bank today, it will become 5,000 in 2 years. Whatever way is convenient for you to understand as for now. And this 5,000 also is not 5,000. It might be only 4,000 here. So these are called the present values. These are called the present values. So the method which I'm going to use here, when you are selling the asset, you use, NRV principle. When you are using the asset, Then what you use, you call it economic value, or you call it value in use, or you call it present value. Okay, these are the names. So if you use the asset, then you value the asset, you do valuation of asset on economic value or value in use, or you call it present value. So it is the, and by the way, this 5,000, this is not profit, this is cash. And I'm sure that you guys understand the difference between profit and cash. Profit and cash are two different things. I'm talking about cash generated, which means inflows minus outflows. So the economic value concept, it says economic value is, it is the present value of the future cash flows generated by an asset. This is the concept of present economic value. So economic value is, it is the present value of the future cash flow generated by an asset. So this 5,000 is actually 4,700 present value. So I'm calculating my PVs here. This 5,000 is 4,500. This is 4,000. And when I make a total, it gives me, 4,000. It gives me 13,200. Now this 13,200 is my economic value. Now, what do I understand from here? That I have this asset in my possession, and this asset, I have two options. Either I can go and sell it in the market, and if I sell it in the market, I can get 13,500. If I don't sell the asset, I use the asset, and if I use the asset, I will get 13,200 value. Cash might be 15,000. Cash might be 15,000, but this 15,000 is not in my hand today. It will come in the future periods, and the present value of that future cash flow is 13,200. So of course, these are the two options. And definitely, you are not going to choose the worst one. You must be choosing the best one. So you take two things and you take the higher of these two. You take the higher of these two. If you know that asset can give you 13,500 today, why would you take 13,200? So you take the higher of these things. So higher of the amounts we take. So I say that here, higher of NRV and economic value is called recoverable amount. So higher of NRV and economic value, between these two, this is called recoverable amount. So recoverable amount is the higher of economic value and value in use. So in our case, recoverable amount becomes, recoverable amount becomes 13,500. Why do we call it recoverable? You know, the name says it all. The name says it all. Recoverable, what you can recover from this asset, what maximum you can recover from this asset, what this asset can give you. 13,500 this asset can give you. Now that's very clear that if I use the asset, I get 13,200. If I sell the asset, I get 13,500. The maximum I can get from the asset is 13,500. Whereas in my books, the asset is shown as 14,000. Balance sheet says asset is 14. Asset cannot give me 14 in any case. Here impairment has happened. Here you can say that impairment has happened. Because when impairment happens when your net book value is greater than recoverable amount. So whenever your net book value is greater than the recoverable amount, which means balance sheet value is higher than the recoverable amount, this is called impairment. I've got my net book value, which is 14,000. I have my recoverable amount, which is 13,500. The difference of these two, this is called impairment loss. This is called impairment loss, 500. Impairment loss goes to P&L. In general, I'm not saying always, I would say generally, so that you guys understand that it is not always. Impairment loss, debit, P&L, the double entry which they tell you, they say, because I need to write down the value of the asset. This asset, which is in my balance sheet for 14,000, I need to bring down the value of this asset. Because your IAS says that, IAS 36 says that assets cannot be shown in your balance sheet at a value higher than the recoverable amount. You cannot show it higher than the recoverable amount. What you need to do, you need to bring down the value of the asset. So you immediately need to make a double entry, which is debit impairment loss, which is a P&L item, and credit my non-current asset, 500. Okay, so I need to do that. It is possible, by the way. Let's suppose that your recoverable amount is not 13,500. Your recoverable amount comes out to be 15,000, which means that asset in your books is 14,000, and you can recover from the asset 15,000. So that's a good thing. What should you do now? If you are following the cost model, you don't do anything, because you remember you have two options, cost model or revaluation model. If you are following the cost model, do nothing. Keep it continue to show it at 14,000. Forget about this thing. Ignore it. But if you are using revaluation model, then you may go for a revaluation because you have a clue that this asset has a higher value. And you are using the revaluation model, then you may go for a revaluation and then you record a revaluation gain. Are we clear until here?
Yes, please.
Okay, now we understand this thing. And if you see that I wrote here generally, I didn't say it always charge it to P&L, because here you need to understand that it is possible that this asset, it might have, and I'm actually right now what I'm talking about. Now let's talk about like this. You talk about impairment of PPE, which is IAS 16, okay? Because there is a different treatment. So I'm talking about impairment of PPE, that goes to P&L. Investment property does not, and by the way, I'm sorry, I should not say P&L. Please correct it, please amend it. It should be if you write it down, impairment loss of PPE, it goes to OCI, other comprehensive income. It does not go to P&L. P&L investment property goes to. Now, impairment of PPE, if it happens. So you need to see that, do you have a revaluation gain against that asset or not before? For example, this particular asset has an impairment of 500, which we see, okay? But we also know that before we had 200 revaluation gain, which means that before we increased the value of this asset. In past, we increased the value of this asset. So we already have a revaluation surplus, in our balance sheet against this asset. So actually it looks like this asset was here, it went up and then it goes down. It went up with 200 and then it goes down by 500, okay? So within 500, this amount, 200, should be canceled out with the revaluation surplus and only 300 will go to OCI. So let's suppose that. So based on this thing, which I just explained to you, I create this thing that we create some example that impairment loss is 500. Previously recorded revaluation surplus. This asset had some previously recorded revaluation surplus of 200. And this 200 was where? This 200 was you already had recorded this thing before. So what you need to do now, you need to reverse this thing. So your double entry will be debit your revaluation surplus, which is 200. Remaining debit your impairment loss. Impairment is only now 300 and credit your non-current asset 500. So if you had some previous revaluation gain, if you did not have a previous revaluation gain, then you should have straight said debit this impairment loss, like I said here. If there is no revaluation surplus account before, then you straight charge it to debit impairment loss. But if there was some revaluation surplus before, you reverse, because revaluation gain was before credited. Now you make it a debit and only 300 will be your loss, because 200 is the recovered amount. Remember, asset, it went up by 200, then it came down by 500. So it means that within this amount, this 200 is the recovery or reversal of your gain, and only 300 is the real drop. The real drop in the value of asset is only 300. So only 300 is impairment loss. Now, here you need to remember the difference between your IAS 16, and let me write it down so that we don't forget, and IAS 40. So you might have impairment loss here, and you might have impairment loss here. This impairment loss, it goes to OCI, other comprehensive income, because it is unrealized and assets are still used in the business. OCI. But when you talk about IAS 40 impairment loss, it goes to P&L. Again, before you take it to P&L, you will do the same practice, like, the revaluation surplus, whatever. If you previously made some revaluation surplus, you reverse it, and the remaining balance you take to P&L. What you need to remember that IAS 40 impairment goes to P&L, IAS 16 impairment goes to OCI. But both of them, before you take them to OCI or to P&L, what you need to remember that IAS 40 impairment goes to P&L, IAS 16 impairment goes to OCI. But both of them, before you take them to OCI or to P&L, you take to P&L. What you need to remember that IAS 40 impairment goes to P&L, IAS 16 impairment goes to OCI. But both of them, before you take them to OCI or to P&L, before that, you must check if there is some revaluation surplus available or not. If it is available, then reduce the amount. Maybe it is possible that you might have, let's suppose that you might have a previous revaluation surplus of 500. You have an impairment 500 and your last previous revaluation surplus is also 500. In this case, there is no impairment loss, because whatever it went up, now it has gone down. So debit revaluation surplus 500, credit NCI 500. So it depends that what do you have there. So this is the first basic concept or understanding of impairment. Now, the question is that what are the indicators of impairment, external, internal, how to measure it, we will discuss it later. Reversal of impairment, cash generating units, allocation of impairment, impairment and goodwill. So this session will continue. It's a long topic, a technical topic, yet interesting. If you have any question, please ask me. But this is the first basic of your impairment.
P&L, right?
Yeah, you see, let me summarize it again.
Yeah.
You have IAS 40. You might have impairment losses, and you might have evaluation gains. So you have P&L, you take them, your gains and losses to P&L. There is nothing else, straight.
Yes.
Gains and losses go to P&L. They cancel out each other. They reverse each other. Last year, in your investment property, you got a hit. It was a loss. This year, it is a gain. In both cases, they go to P&L and they balance it out with each other in your P&L. It is management's decision. You don't have the concept of other comprehensive income or revaluation surplus in case of investment property. In case of IAS 16, you have a different treatment. In IAS 16, your gains are in OCI. Gains are in OCI, that is for sure. And your losses, your impairment losses are in P&L. But before you take them to P&L, before impairment losses are in P&L, however, previous gains are deducted first.
This is what my question.
From OCI. But if you have an impairment loss, the rule is that because we know that it is an impairment, it is loss, because impairment is what? Impairment is extra depreciation. So where depreciation goes? Like I was explaining you before, that if I have a book value of 40 and my market value recoverable amount becomes 35, it looks like, so it started with 100, I charged 60 depreciation. So it looks like that I did not charge depreciation properly. I should have charged 65, maybe I charged less, maybe my estimation is not correct. My depreciation estimation is not correct. So this 5, I should charge further. So this is kind of extra depreciation. So where the depreciation goes, impairment should also go to the same place.
So imagine the situation.
Which is impairment losses in P&L. But there is an exception that you might have some previous revaluation surplus. If you have revaluation surplus, then first you remove that revaluation surplus. Let's suppose that your loss is 5. You have your revaluation surplus of $2. So then what you do, that only $3 will go to P&L. But if there is no revaluation surplus in past, then all of the $5 will go here.
Yeah. So imagine the situation. It is the first time we are just making the impairment test or a revaluation, and the end result is an impairment loss. In that cases, it will be directly charged to P&L because there is
P&L. Because you know what happens? Impairment is, it is essentially, you see, I tell you 100 minus 20, and then second year minus 20, third year minus 20. It looks like 60. So you said 40. You said that my book value, my net book value is 40. Now, who told you that this is 40? This is your estimate. Market is standing at 35. So I have a doubt on your calculation. You might not have calculated depreciation properly. Instead of charging 20, maybe you should be charging 22 or something. Understand my point? So I see impairment as extra depreciation. I see impairment as extra depreciation. So it should go to P&L logically. But if there is any previously recorded, registered revaluation gains, let's first settle those revaluation gains, and remaining part we transfer to P&L.
Okay, clear.
Okay.